Hello everyone, so this is a follow-up video on the previous one on the double entry system for the asset of inventory. Very important for us to know as we move on to today's lesson that the double entry rules still apply and will never change, meaning that assets will always increase on the debit side and they will decrease on the credit side. Liabilities and capital have the reverse rule. They increase on the credit side and decrease on the debit side. Now, if you recall from previous classes, we have never ever opened a T account with the name inventory or stock of goods. Never. And the reason for that is because such account does not exist. In accounting, the movement of inventory is tracked by using 4 accounts, namely purchases, sales, return inwards, and return outwards. Those are the 40 accounts that we create instead of creating one account such as inventory. So keep that in mind as we go by. Now, how do we use these accounts? I have a very good example, I believe, on the previous video. So if you do not fully understand the example I will give you now, feel free to watch that other lesson that I uploaded as well. So let's, for example, if you had a bookstore, day one, you need books. If you have a bookstore, you need books for your customers, future customers, right? So every time you buy books from your supplier, you would use purchases, okay? And let's say day one, you buy 1,000 books. So you would record that particular purchase of inventory on the T account name purchases. Now, purchases is considered, purchases like the other 4 accounts that I have here are considered asset accounts. So that means that they increase on the debit side and they decrease on the credit side. All of these accounts have that rule because they fall under the category of asset accounts. Now, if I will use purchases when I buy 1,000 books for my bookstore, then that means that inventory is going up for me because now I have more books or have books at my particular bookstore. So every time I will use purchases, I need to show an increase on this account. And if purchases is an asset account, I will show that increase by doing a debit entry. Now, I have my 1,000 books. Day 2 of business, let's say that I sell 20 books to my first customer. So that sale of the 20 books, which is inventory, the sale will decrease my inventory on my shelves, for example. So if I want to show a decrease on inventory because of a sale, I will use the sales account. And if my inventory will decrease, I want to do a credit entry on the sales account. I'm missing a comma here. Okay, so let's say that the customer who purchased from me the 20 books is unhappy with 5 of those books and he wants to return them. So if he wants to return and if he returns those books to me, those books will come back into my business. As a result, my inventory will go up because of that return. Given that that particular number of books being returned is coming to my business, my inventory will go up. I need to show an increase of that particular transaction. But you must keep in mind that those books are being returned back to me, so it's coming back in. So I will use the account with the name return inwards. And what will you show? Well, you will show an increase on inventory, as I said, and the way you show in an increase on an asset account would be to make a debit entry. And lastly, let's say that the 5 books that the customer returned, he was right. He was not happy because he had a good reason he did not like them. And I share that same sentiment. So I decide that I will return the books to the same supplier that sold me the 1,000 books at the beginning. So I will return the books that a customer returned to me, I will return it to my supplier. So the books will now move from my establishment, will move outwards. So when I return to my supplier, I will use the return outwards. And where do I record the return outwards? Well, inventory is going down when I return to my supplier. And if I am returning to my supplier, that means that inventory is going down. To show a decrease, I would need to do a credit entry on return outwards. As I said, I believe I explained this a bit slower and a bit better in the previous video, so feel free to look at that video if something was unclear right now. At this point, we can say that purchases will always be debited, sales will be credited, return inwards debited, and return outwards credited. Now let me spend a few minutes on explaining a few transactions that will perhaps help you more. So for example, here I have transaction number 1 that says goods bought on credit from T. Morgan. Now, before I go into tell you what to debit and what to credit, keep in mind that the minute you see the word goods in any particular transaction, you know that one of these 4 accounts will be affected. It's just a matter of trying to determine which account. So the minute you see goods, think, will I use sales, will I use purchases, return inwards, or return outwards? Now here, goods bought on credit from T. Morgan, what are we doing? The word goods is right there. Well, we are buying, okay? So goods bought on credit. So if we are buying, that means that we will debit purchases. We will debit purchases. What will we credit? Well, we owe T. Morgan, so I will credit T. Morgan. Now, why did I debit purchases? Well, I debit purchases because when I buy goods, my inventory will increase. To show an increase in inventory, I will use purchases because I bought, of course, and to show an increase, I will need to do the debit entry. Now, T. Morgan was credited because T. Morgan is a liability. To show an increase in the liability because we owe him, we need to do a credit entry. So that's the reason why T. Morgan will be credited and purchases will be debited. The other transaction says goods returned to us by J. Thomas. So the minute we see goods, we know one of these accounts will be affected. So which one? What is happening with goods? Well, it's being returned. Returned by whom? By us. So if it's being returned by us, that means that the goods are going out of our establishment. So we need to use return outwards. But will we debit or will we credit? Well, when we return goods to our supplier, that means that we have less inventory. And to show a decrease in inventory, in this case would be return outwards. So show a decrease, I need to do that on the credit side. So I will do returns outwards. What will I debit? Well, it's being returned to J. Thomas. So I'm going to debit J. Thomas. But why am I doing a debit entry on J. Thomas? Well, simple, because this J. Thomas right here is a liability. So I owe this particular supplier less. How do I show that I owe less for a liability? I do a debit entry according to the rule that I have here. The following transaction. Machinery returned to L. Jones Limited. For this particular transaction, we do not see the word goods. So that means that we will not use any of these accounts because we do not see that word. So we go back to the previous chapter and figure out which account will we use. Well, what are we returning? We are returning machinery, which is considered an asset, and we are returning it to L. Jones Limited. So if we are returning machinery, that means that we will have less machinery or perhaps no machinery at all. So that means that I need to do a credit entry on this particular asset. The way I do that is by doing a credit entry. Machinery. What will I debit? To whom did I return it? I returned it to L. Jones Limited, which is a liability. So now I owe L. Jones Limited less. The following transaction, goods bought for cash. Here we see the word goods, so we know we will use one of these accounts. Goods bought for cash. If we're buying goods, that means we will use purchases. Purchases, we need to do a debit entry on purchases because our inventory is going up. We show an increase in inventory or any asset account by doing a debit entry. So purchases will be debited. What will we credit? Well, we will credit cash. Why will we credit cash? Because we have less cash. Cash is an asset. We show a decrease in assets by doing a credit entry. So cash will be credited. The following transaction. Van bought on credit from D. David Limited. We do not see the word goods here, so we know automatically again these accounts will not be used. So we are buying a van. This is an asset. How do we increase assets? By doing debit entries. So van will be debited. How did we get the van? We got it on credit. That means that we owe someone. Who do we owe? D. David. So if D. David, if we owe him, that means that D. David is a liability, and we show an increase in liabilities by doing credit entries. So I will credit D. David Ltd. Transaction number 6. Goods returned by us to I. Prince. So here we see the word goods, so we know automatically that one of these accounts will be affected. What is happening with goods? Well, it's being returned. Returned by whom? By us. So that means that the goods will go out of our establishment. Hence, if it's going outwards, we will use the return outwards. What is happening to inventory? It's decreasing. To show a decrease in inventory, we need to do a credit entry. Returns outwards. Now, to whom did we return it? We return it to I. Prince. I. Prince in this case is a liability, so we owe this particular liability less. To show that, we do a debit entry. Remember that liabilities decrease on the debit side. The following transaction, D. Picton paid us his account by check. Here, we do not see the word goods, so automatically we know that these accounts will not be used. So, who is paying us? D. Picton. How is he paying us? With a check. So that means that we will have more money at the bank. Increase this particular account, so that will be debit the bank. What will we credit? Credit D. Picton. Why will we credit D. Picton? Because this is the customer, falls under the category of assets. So D. Picton owes us less. We show a decrease by doing a credit entry. The following transaction, goods bought by check. Here we see the word goods, so we know we have to use one of these accounts. Okay, what's happening with goods? Well, we're buying goods, goods bought by check. So that means that we will have more inventory. How do we show that? By doing a debit entry on purchases. How did we get the goods? Well, we paid with a check. So that means that we will have less money at the bank because of that purchase. We have less money at the bank, but we have more inventory for resale. Transaction number 9. We paid creditor B. Henry by check. We do not see the word goods, so none of these accounts will be affected. So we are paying B. Henry by check. So that means that we will have less money at the bank. So credit the bank. What will we debit? We will debit B. Henry. Why did we debit B. Henry? Because we are paying this particular account, and that means that we owe them less. This is a liability. We show a decrease by doing debit entries on liabilities. And the last transaction, goods sold on credit to J. James. So here we see the word goods. They're being sold. This is the first time we're using sales for this. Anyways, you will get the idea, I hope. If goods are being sold here, you will use sales. Will we debit? Will we credit? Well, what is happening with inventory? Well, inventory is going down. We are selling, but inventory is going down. Do not confuse that. So what we need to do is we need to do a credit entry on sales because our inventory is going down. Every time we sell inventory, we'll do a credit entry on the sales account. What will we debit? Well, we will debit J. James. And why? Because we are selling to this particular person, and that means that this is an accounts receivable which falls under the asset accounts, and assets increase on the debit side. On the previous video, I believe I have more examples using sales, so feel free to look at that particular video. And if anything is unclear, feel free to bring your questions to the next class.